Hello, everybody. Welcome to Wall Street Hackers, one of the popular shows on the Pod TV network. I'm Nick Palavita. I'll be the moderator for today's show. And with that, we're going to look at the markets. We're going to introduce Peter Bennett, look at the markets. We're also going to look at quotes of the week, stocks of the week, and Peter's picks. With that, we want to bring in the hacker himself, a graduate of UCLA with a degree in economics and also a law degree, a master's in business administration from NYU, and 17 years on the streets of New York peddling stocks, or basically doing analytical review. And with that, let's bring in the hacker himself, Peter Bennett. Peter Bennett, welcome to your show.
Hey, Nick. I actually never peddled stocks. I worked on
you did? Oh, you're an analyst. That's a different story. Okay.
And different positions, management, things like that, but never peddling stocks itself. But that's what the industry does, to your point. So welcome to Wall Street Hackers. You can catch a new episode most weeks, starting on Thursdays or Saturdays, Thursday one or Saturdays, depending on your distribution channel. It's July 25th, 2024. We will have a show next week, and then that's August 1st, starting that week. And then after that, we'll take a brief hiatus for about 3 weeks until after Labor Day. We'll be back. I think it's September 5th, Thursday, September 5th that week. So taking a couple of weeks off. We are on most of the weeks, and I was looking at shows like Yellowstone, different shows like that, where they film 13 weeks or 26 weeks. We do a lot more than that. Anyway, the market. So the news story, I guess, on the street that's been sort of, I was going to say peddled, but that just came from what Nick said. But many of the people on the street are saying we have started, quote, the great rotation. And it's moving from tech to other companies like small cap and international. Well, Wall Street Hackers is not at all convinced of that. Admittedly, on one half, we were concerned 2 weeks ago, and we were kind of ahead of the game there on bringing out surveys about AI that were said a lot of companies are getting skeptical results on that. And AI hasn't obviously been doing too well lately. But just because AI is doing well, it doesn't mean that necessarily small cap or international or anybody else, any other sectors will do well. I mean, it all depends what the economy is doing. And there's still the issues of possible inflation and now growing possibilities of recession. So those issues remain. And it's not necessarily like just because there's a lot of cash and people are moving out of tech that all of a sudden they're going to pour into some other sector. Of course, we always like our philosophy, which is not really dependent on what the market's doing, more on buying solid businesses. But for many investors, it's been like running on a treadmill. The S&P has hardly made any progress against inflation or zero since December 21. And if you look at the Vanguard Russell 2000, which is the story of the day, people are moving into small caps. It was at about 85 in May 24, and this morning was at 88. I wouldn't call that a great rotation. I'd call that a bear movement, if anything, especially subtracting inflation. So we'll see where that goes. But back to the AI story, because more and more keeps coming out. Again, we were weeks ahead on this one, but we're not saying, by the way, that we hate AI. We don't like AI. Most of our companies aren't tech anyway. I like Amazon. I'll mention it now. The only tech position we have right now is Amazon, but it's a very defensive position. I recommended selling 200 puts at about 35 or 30 something 2 weeks ago as a very small, and I said speculative investment, and then I said cover with other puts like at 145. So you're not risking that much. Again, 2 to 3% total risk allocation. But now I have to say I moved it up to 175 because I don't like what's happening in tech. So this is a trade where I think Amazon's the best tech company. I think this has less antitrust issues, great execution, not subject to as much, although some international strife. So I think it's the place to be in terms of safety, and selling puts at 200 and means basically if it's somewhere around 175 in 2.5 years, because I'm talking about very long-term puts, I'll just walk away at the premium, and I'll adjust from there. But If it goes a lot, I'll probably sell the 175 puts and just hang on until it someday gets back to 200. I can keep selling those forever, probably. So anyway, back to AI. Here's some really interesting things that came out in the last week that goes along with the other material. And that is this story. It's a quote from Darren, I don't know how to say his name, Acemoglu, but he is a professor at MIT, and he was speaking on the Goldman Sachs podcast, Goldman Sachs Exchanges podcast. Here's what he said, quote, "The large language models has proven to be impressive than many," that's not even English, "to be more impressive than many people would have predicted, but I think it takes a big leap of faith to say that this is an architecture of predicting next word. We're going to get something that's as smart as HAL in 2001. He's saying it won't be as smart as HAL in 2001. There could be severe limits on where we can go with the current architecture. Quote, he also said, we're a couple of years into this, and there's not a single thing that this is being used for that's cost effective at this point. I think there's an unbelievable misunderstanding of what the technology can do today. The problems that it can solve aren't big problems. There's no cognitive reasoning to this." Now, whether or not you agree to that, one more piece of evidence, Alphabet came out on its earnings call, and it revealed a possible delay in AI adoption. And it said that it may have over-invested in AI CapEx. These are not positive AI terms. Again, we have no specific investments relating to AI except for Amazon indirectly, and we have no positions on it. But I will say that if AI busts, there are stories out there that could be a little bit or a lot like the dot-com bust of 2000. I have no idea. But if it's a big bust, that's what's been driving the market up for years. So if they start crashing, I don't see a lot of support there. So it could be a dramatic fall in the S&P 500 again. We're not shorting it. We're not long it. We're just saying there is risk there for sure in both the great risk rotation and in tech right now. So following up on other issues, I'll just add, the main issues of inflation is still there, as I said, and there's a lot of concern now rising about the S&P 500 and the economy may be going into recession, which if inflation stays up and recession occurs, then that is typical stagflation. One more story about the S&P, the Russell 2000. So this is another quote, very interesting. I saw it this week. And it's a quote, this one's from Barron's. "Only the very worst companies are left in the small cap space, according to BCA research report cited in the latest Grant's Interest Rate Observer. The best new companies don't need to go public as they're staked by venture capital and private equity, which in turn is funded by private credit. By contrast, 42% of Russell 2000 cohorts reported losses in the past 12 months. So I'm not saying we won't invest in any small caps because we like everything to a point. I look at small caps, large caps, mid caps. The problem is among thousands, tens of thousands of possible investments, it's so hard to find what we're looking for, which is, good income generally, strong dividends or growth, and good balance sheets and high cash flows. So, and that is our philosophy. We've been doing this for years. And history shows, as I always mention or frequently mention, that this is the way to go. Why? Because now we have the Morningstar study for 95 years. We have the Hartford Fund study over 50 years to 2022. And they are indicating very strongly that if history is worth anything, you need to be in dividend stocks and dividend growth stocks because they far outperformed the non-dividend payers and the S&P 500 as a whole. And also other studies we've always citing, which show energy is also the place to be. So this week and next week, we're going to cover food a little more, which is pretty safe sector. And then after Labor Day, I'm going to get back into utilities. So for now, though, if you haven't been watching the show, I still like large allocation MLPX, which we've done very well with. You can pull up the charts that I've been recommending for years. And it still has an 8% dividend, and there's certain tax advantages to that. Also 3% KRP. You can pull up the chart on that one. Very solid energy producer that has I think it's 17% of all rigs right now, or 16% of all rigs in the United States operating on their land. They own huge tracts of land. So I think it's solid. But again, KRP 3%, because if there's a big recession, even oil prices can go down. Maybe if, I'm always watching it, but it's my favorite place for an energy producer. So most interesting stories of the week. We have two this week only because we have a long panel discussion potentially. So interesting story number one. Last week, our panel discussion was on how absurdly ridiculous MSNBC is, and how it's a proxy, by the way, for many of the other media that gets ridiculous. We mentioned last week that in about 50 visits to MSNBC's coverage on the Republican Day Convention 2, Republican Convention Day 2, there wasn't a single speaker that was allowed to speak. In other words, they were all shown in the background, muted, fully muted, except then finally Nikki Haley came on. She spoke a little while, and then they muted her. So they didn't allow any Republicans on their live coverage of the event on that day. But then I went back on day 3, just for the audience, basically, because I knew what was going to happen. So I've made maybe 40 visits to MSNBC on that day. They totally muted again every single speaker until the very last speaker, who was Trump, and they actually let him speak, I think, for the whole time. But you're talking about hours and hours of supposedly live coverage with everybody muted. But here's more to it. It also turns out their, quote, live coverage wasn't actually in the convention at all. It was a green screen. The reporters were in front of a green screen in a film studio, if they still call it film studios. It was in a studio. So apparently live means little or no actual live events. In other words, you don't get to hear anything. You don't really get to see the convention. You only see a little distant shot of, a picture, and that's supposed to be live. But even if you don't object to that and think it's live, one more story, and I won't be doing this every week. If you want to watch MSNBC, go ahead. But I have to follow up on this MSNBC because it was psychotic. I mean, it's really psychosis. So here's what I heard in that last day or so. First of all, Joy Reid attacked RNC Speaker Amber Rose, and she actually said that Amber Rose was, quote, racially ambiguous in order to delegitimize her because she was talking to minorities. In other words, if you're a minority, you're not allowed to be in support of the conservatives. I think that's pretty discriminatory. Reid also asserted that the Trump assassination attempt, this is on mainstream TV, was a setup. She actually said it was a setup. Reporter Wagner criticized J.D. Vance because he said, I think there's a quote, America is a group of people with a shared history and a common future. And so that was supposed to be a negative, a shared history and a common future. And Wagner insisted this isn't true at all. But here's the winner, Rachel Maddow. So we have something that came on. Nick, we're having a technical difficulty. I'll keep speaking. There you go. Rachel Maddow criticized J.D. Vance. And you have to follow this one because it's pretty amazing. So Rachel Maddow criticized J.D. Vance because his mentor, not J.D. Vance, his mentor, named one of his multiple companies, just one, Narya, N-A-R-Y-A. Now, that's a word from Lord of the Rings. And Meadow was pointing out that if one letter from Narya is moved, it spells Aryan. So, in her mind, a single word from Lord of the Rings, which, by the way, is a very strong environmental novel, and also J.R. Tolkien was very anti-authoritarian. a single word that was adapted for one of his companies, a mentor, not J.D. Vance himself, if rearranged by one letter, spells Aryan. If you met somebody on the street who was making that argument, you would seriously consider whether or not they should need to be institutionalized. They would definitely need care. So my bottom line on MSNBC is I would think that watching The Simpsons would be much more educational than watching MSNBC. At least you get some real information. It's amazing that this is on and so many people still watch. It's so misleading. Interesting story, too. Tesla says it will have humanoid robots in low production for the company's internal use during next year. The automaker says, hopefully, it will have the robots in high production for other companies in 2026. Musk said in April that the Tesla robot called Optimus, which does look like a person, pretty much a metal person, would be able to perform tasks in factories by the end of this year and could be ready for sale as soon as the end of 2025. Now, of course, Elon Musk does have a history of sometimes being off schedule with his projects, but robots are coming, household robots are coming, the future is coming. So moving on, one quick break. I don't get a break anymore because there's no advertisement. Dividend pick of the week. And we are actually on time, Nick, for actually we'll have hopefully to be able to finish the discussion this week. The question of the week. Okay, dividend pick of the week. Disclosures. As always, Wall Street Hackers is for entertainment only. These are only our suggestions. Nobody can guarantee any investments. You can only guarantee a CD or a treasury. And if you sell it early, there's risk there. Consult your financial advisor. So this week, a very interesting selection and one of my larger allocations, especially if you exclude bonds and MPLX in the energy sector. And that is Slate Grocery REIT. SRRTF. We have an aggressive 7% allocation there, but it's in a 401k. So in a way that reduces risk because it's after, it's pre-tax money. And I'm not saying you should do 7. It's up to you. Everybody has a different portfolio, different risk tolerance. But I keep it in the profit sharing is to avoid double taxation because Canadian investments generally, and this could have a 15% Canadian withholding tax on dividends. So you get I don't want short-term double taxation. So I think that's the best place to keep it in a qualified plan. Slate's a Canadian REIT, but it owns exclusively U.S. properties. And here's what I like about it. Number one, it owns open-air shopping centers. I've been avoiding malls for years, not personally, but in terms of investing, I don't think the trends look good there. But open-air shopping centers are necessity locations. And the thing about Slate is they're very strategic. 100% of their shopping centers are grocery anchored, and that just pulls people in. The grocery industry is generally very healthy. So there's demand for the space. They have high occupancy. And also, it's interesting, but there's building almost no or very little open-air shopping centers in the United States anymore, or probably anywhere. Because one, there's very high cost of construction to limited land and good locations. So this seems pretty solid as a long-term investment, and it could be a growth investment too. The centers are in 24 states also, and I like the fact that they're southern-oriented. A lot of them are in the South, and some are in Texas. So they're thinking long-term. And the stock has a current yield of 9.7%. And the cash flow and AFFO are covering the high dividend. So with that kind of dividend, if it just maintains, I'll be happy. But eventually, I expect they're going to have growth because the in-place rents are very much below the market. I think it's about 12 something a square foot when competitors are $21 or $24. There, you can look at their website. It's always good to go to the company websites and you can pull up their presentations. But their leases are so much below the market, and there's a bunch that are going to come due soon and in the next few years, and eventually the leases come due. And when a $12 lease comes due, the tenant is going to be subject to the fact that, well, we want $24 or we want $20. So there's a good chance that they're going to have a lot of growth. And it's a great diversifier too, because you can't only be in long-term bonds, which I like as part of a portfolio, high coupon treasuries as the safest part. You know, I look for very high coupons in long-term, and then a stock like MPLX, but you need diversifiers. And this is a pretty solid diversifier in my mind. Now, why not even more? I did have a bit more, and now I scaled down to 7. Well, one, oh, we're having another technical glitch. You got to watch that. Thanks. Debt to assets are a reasonable, but not exceptional 0.52. It's pretty average. So decent debt. Now, if we weren't in this interest environment, I wouldn't even worry about 0.52. But I am concerned about higher rates for longer, which could affect every single stock in every, almost every stock in the market is going to be affected by that. Almost. There are some exceptions. But basically, if rates stay really high, they do have some maturities coming due in the next few years, in 25 and beyond. So in a worst case scenario, in my mind, maybe they cut the dividend, maybe they never do. Maybe they cut it to 7%. It would still look great at 6 or 7% or 8% or whatever, because most REITs have worse figures in terms of the fundamentals, cash flows and things like that. And they have much lower dividends. Maybe you get 4 or 5 in a typical shopping center REIT. So it's just basically undervalued. If you look at, again, the presentation, you'll see the arguments they make about valuation compared to other very well-known REITs that you might recognize if you look at REITs like ADC and O, and it looks pretty promising to me. So I like it. I'm watching everything in this market, but I think I'll probably be holding it for life, hopefully, like I like to, and for income for life. So we'll see. Panel question of the week. And we're a little tight, Nick, but we have time. It always takes time. We cover a lot in the program. Question is, how dangerous is Kamala Harris to the economy and to America's future? Background. Democrats have almost certainly or likely, hey, Kim, we're going to all have to go really fast now with this rating.
I had something I wanted to share with you about.
Wait. We don't have time, Kim.
So go ahead.
We're already pressed for time. I know how long these discussions take. Democrats are likely selecting Kamala Harris as Biden's replacement. Here's what the issues are. One, Kamala has had a 92% turnover in staff in just 3 years. That is horrible. I mean, if you worked in a company or in a government and you had 92% turnover in 3 years, somebody would be thinking this is a sign of incompetency right there. She had 47 staff members hired in 21 and only 4 survived to March 24. But okay, let's say we don't mind that. And by the way, she has a reputation for creating disorder among subordinates, and she's supposed to be so happy and smiley, but there must be something going on there. Number 2, honesty. Obviously, everybody knows she's been covering up or in denial personally about Biden's health issues. I mean, this has been for years. So she either didn't notice or she covered it up, either one. Next, she has been called the border czar. The new thing on MSNBC and others is she's not really the border czar. Nobody said she's, quote, the border czar. But in 2021, Biden handed her the task of controlling immigration in different ways, and he said it, and she was handed that task. So it's just more slant, whatever it is on MSNBC and others, saying, "Oh, she's not the border czar." She was tasked with controlling the borders. I can give you the quotes. So, but here's the other thing: with this task, she has never met with the Border Patrol Chief Jesse Owens. Never once met with him. She visited the border once in 2021 in El Paso, Texas. And when her spokesman back in 2006 in San Francisco said that San Francisco is a sanctuary city and always will be. So that's basically her positions. She also did a speech where she compared ICE enforcement to the KKK. Let's get to the economy. She has said an 80% tax rate, and I don't know what that is, an 80% tax rate would be fantastic. Can we take that off?
Oh, that was going to be part of my discussion with the
Can you take that off, Kim?
So, okay.
Thank you. Well, I'm not ready yet. An 80% tax rate would be fantastic. 80% is higher than we had under Jimmy Carter, and we know the economy was in a, quote, malaise. She spoke about rent control in a very positive way. So she was in favor of rent control. Even whatever she said, if the Trump tax cuts are expired in this is 100%. If the tax cuts from Trump, which were the largest tax cut in history, and are set to expire, unless somebody stops the expiration in 2025, this will drive the economy into recession, 100%. A very severe recession that's going to affect the middle class. That is sure. Maybe Harris will support that, but I don't see it if she was president. In 2019, she said that she wanted to abolish private health care entirely. She has, during the Jussie Smollett hoax, she said, talking about uniting people, she said it was a modern day lynching. It was actually a hoax. She was in favor of the Defend the Police movement and applauded Los Angeles for cutting police budget by $150 million. She urged donors to contribute funds for the rioters for bail in 2020. I won't go on because we are running out of time. Oh, one last one. She actually had the incompetency, even if you agreed with this, which is crazy, to say she's in favor of banning fracking. Where did she say that? In Pennsylvania. Who would say this in Pennsylvania? This is not the place to be. If they ban fracking, it's going to be terrible for the environment. It's like the Biden administration policies that we're always criticizing that are terrible about the environment, because you're going to have less natural gas and more coal. We got to go 1 minute each. Go ahead, Kim, if you want.
Well, I want to show that Trump had a 92% turnover rate when he was an admin. So maybe that just shows good leadership. That
over 8 years?
You've got, yeah. So
okay, good
Trump
counterpoint.
had 92%. They show all the president's turnover rate. So I just wanted to show a fact rather than just word something out. I wanted you to see I'm not making this up.
Wait,
so
Kim,
I want to enlighten you. And I want to tell you something. I worked in oil gas industry. I walked the rigs. The most dangerous rig is the fracking rig. It also allows people to evade other people's land without their permission. So I am not in favor of fracking. I will go for drilling, but I am not in favor of fracking. It is very,
okay,
very
2 points, Kim, at least. There is some one very good point about the 90%.
Well, I know more about it than
let
you
me
do,
talk.
so I am going to say this is one
Kim,
thing I do.
You got to be quiet now.
So.
I'm sorry, I wasn't expecting on the program to begin with, and we're way too tight for time. So number one, excellent point. I have to admit, 92% was too high for the Trump administration. However, I would point out that was
Trump, not just the administration.
Don't talk right now, Kim. Don't be rude. That was over 8 years and not 3 years. So that's a huge difference, but that is high. And I'd have to look into it. But if it's true, that's of concern, I would say. But also, and it's not necessarily people working directly with Trump, but I have to look into it. And I might agree with you. In terms of fracking, it is a little dangerous. If we didn't have fracking, not only would America be destroyed economically, I mean, totally. Oil would be $250 or $300 a barrel right now. Our economy would be in deep depression. The environment would be terrible because we'd be using coal. It is a little dangerous, but people are paid a lot to do those business jobs, and they take those jobs. So I think we're going to run out of time now anyway. We are out of time. So thanks for watching Wall Street Hackers. Maybe we'll finish this up next week because I did have a few points, and we'll try to focus more on that. But that is a good point about the 92%, Kim. I will look into it. Thanks for watching. As Kim always says, get healthy and get wealthy. We will see you next week, and then we'll be taking a break until September Labor Day. Thanks. Bye-bye.